Hi everyone, I'm Connie, Mortgage Advisor and Managing Director at Prosperity Finance. It was a big surprise when the Reserve Bank of New Zealand unexpectedly slashed the official cash rates by 50% 2 weeks ago. They had previously only indicated a 25 basis point cut, and many economists were expecting just that. A few days after the announcement, the inflation data was released and was reduced to 2.2%, the first time within the Reserve Bank targeted range since COVID. It was a big relief for those of us who have home loans because it just gives us the confidence the interest rates are trending down. The next official cash rate announcement is set for the 27th November. Whether we are going to have another cut and how much the cut going to be will depend on some further upcoming economic data, such as unemployment rates. So how are the banks reacting to this? ANZ just jumped in even before the Reserve Bank made the announcement. They cut the one-year fixed mortgage rates to 5.59, cut the 6 months rates to 6.34. Now, at the time of this video was recorded, BNZ and ASB can also match ANZ rates. If your mortgage is not with these banks, don't worry. My personal opinion is that more banks will likely follow the suit in the next few days. Now, I know many of us are wondering if it's worth breaking your current mortgage rates to lock in a lower rates. My advice is that breaking fees often end up costing as much, if not more, than the interest rate saving you would get. Plus, you have to pay this fee upfront, so it might not be worth it. If your mortgage is upcoming for renewal soon, congratulations, you are in a great position. When it's time to fix your rates, I would recommend wait until close to the rate fix due date, and I will consider either 6 months or 12 months term, depends on the difference between the two terms. If the 6 months rate is significantly higher than the 12 months, it's probably not worth going with 6 months. Another option is to split your loan, fix part of it for 6 months and the rest for 12 months, which help you spread the risk. Your personal situation also matters. If you are thinking about selling your house in the near future, a floating or short fixed term might be your best option. But if you are not sure about your future income or want to have more stability, a 12 months fixed term would give you a peace of mind. When it comes to repayment, if your new rate is lower than before, you got two options. First, you can reduce your monthly repayment, which is great for your cash flow, especially if you got investment properties. Second, you can keep the payment at the current level, which will help you pay off your loan faster. This option works well for those who can handle the current repayment amount. For anyone about to settle a new loan, I recommend you opt in for floating rates when the loan documents is made, and then fixing the rates straight after settlement. This will give you more flexibility and more likely to lock in a lower rate and save $1,000 a year. Finally, a lower interest rate won't just reduce your interest costs, it will also increase your borrowing capacity. As banks adjust their interest rate in line with the actual interest rates, you might be able to borrow more, even if your income hasn't changed. However, just keep an eye on the debt-to-income ratios. As more people rush to take out loans, banks might start tightening their lending rules. So the earlier you get into the pre-approval stage, the better. If you have any question about your mortgage or need some advice, feel free to get in touch with us. We will do our best to help you achieve your financial goals. Thank you for watching. I will see you in the next video. Bye-bye.